Hey everyone, welcome back to Corporate Decoder. Today we're diving into the PNC Financial Services Group's latest filing. Forget boring banking jargon, we're here to decode whether PNC is actually making money or just shuffling numbers, and if their executives are being rewarded fairly for it. Get ready for some serious financial tea. First up, it's that time of year again. PNC's shareholders are getting ready to vote on some important stuff. This year's annual meeting is scheduled for April 23, 2020, 2020, 2020, 2020, 2020, 2025. And it's going to be a virtual-only affair, which is pretty common these days. One of the main things they'll be voting on is electing the board of directors. There are 13 nominees up for the job. Basically, shareholders get to decide who will be overseeing PNC's operations for the next year. It's also time to ratify, meaning approve who will be doing PNC's accounting and compensation for its executives. Now let's talk about how PNC actually performed last year. The filing is boasting about a strong 2024 with record revenue and a growing customer base. But as we're about to see, it's crucial to dig deeper than the headlines. They're highlighting revenue of $21.6 billion, a slight increase from last year. That sounds good on paper. And their CEO is getting paid $22.3 million. But let's get to the real meat of the filing. How did they actually manage that? We need to look at some tables. Diluted earnings per share, or EPS, is a key measure of profitability. PNC reported $13.74 diluted earnings per share, which increased cents, which is still up 3%, and the RO went down. This small change tells a bit of a different story. They're making money, but maybe not as efficiently as they were before. Is the CEO deserving of his pay? Iniawo went down. This small change tells a bit of a different story. They're making money, but maybe not as efficiently as they were before. Is the CEO deserving of his pay? Another important measure is tangible book value per common share, which is a company's value if you subtract any intangible assets like goodwill. Their tangible book value per common share was 95.23 cents, which is up 12% from the previous year. This suggests that PNC is getting better at scaling without losing that value, as if they are making actual new cash-generating services. The filing also talks about corporate governance, which is all about how the company is run. There is a substantial majority with independent directors. This is meant to provide balance and make sure no one person, like the CEO, has too much power. The CEO himself made $23 million. Is he worth it? We need to know who he is. William S. Demchak is the chairman and CEO. They say it's important to have the CEO on the board as he can bridge the gap between the board and the management. His experience and leadership give the board some perspective. We should also take a look at who was newly appointed. Douglas Dachel is one of the new independent director. The board has a presiding director, Andrew Feldstein, who serves as the lead independent director. This is a good thing because it means there's someone independent keeping an eye on things separate from the CEO. This person will also convene and preside at meetings. Speaking of oversight, the board has several committees that do a lot of the heavy lifting. For example, there is an audit committee to oversee accounting and auditing, and then there is a Human Resources Committee which deals with human resources. The compensation for our executive management is given to this committee. It will oversee successions, risks, talent, and a lot more. It is the most important one when talking about our CEO. Now for the juiciest part, the CEO pay ratio. The CEO to median employee pay ratio is 179 to 1. That means the CEO makes 179 times what the median employee makes. This always raises questions about fairness, regardless if the ratios are within range of the peer companies. So how does PNC decide how much to pay its directors? For every board member, it is cash retainer Clesi of annual equity retainer, but the higher positions have higher compensations. Seems fair, but let's check this out. The little peek at our financial table reveals that at 68 years old, Richard J. Harshman has $344,915. His board experience as well as Pittsburgh community is valuable to the board, at least they claim that. We also see who the big shareholders are. The Vanguard Group owns 9.3% of the shares and BlackRock Inc. owns 7.4%. These big players get to have a major say in what happens at PNC. Overall, PNC paints a picture of a company that's performing well, but with some challenges ahead. They're trying to expand into new markets, but they're also facing pressure on expenses and competition for top talent. It will be interesting to see how they navigate this going forward. However, let's cut through all the corporate speak. While record revenue sounds great, the smaller increase than previous years hints at growing headwinds. The CEO's pay package, it's hefty even by Wall Street standards, and the board needs to make sure it's truly justified by exceptional performance, especially given that the average employee is not getting this kind of compensation. The emphasis of the word that they are thoughtful of credit selections makes me think that this part of the company is having difficulties. PNC appears to be in a good position. They seem to have enough funds to continue and to return value. There is no particular aspect that makes me very bullish other than the high dividend. Thanks for watching Corporate Decoder. If you found this breakdown helpful, give us a like, drop a comment, and definitely subscribe for more deep dives into the world of corporate finance. Until next time, stay curious and keep decoding.